Welcome back. You're tuned into Trading Hour on CNBC TV18. Well, as promised, Manisha is joining in, and today we are focusing on ethanol and sugar, Manisha.
We are, yes, because we've seen good price moves come in for this one, Sonal, and I want to start with ethanol prices in the international markets, where we are seeing a 6-year highs there. $2 per gallon and above is what the ethanol prices there are. We have seen the US ethanol inventories at a 21-week lows. When you look at the US blending demand, that is at a 13-month highs, and the Indian market's clearly taking a lot of cue from that too. We already have seen a lot of commodity prices run up because of the green fuel, biofuel kind of stories that the US and much of the Western world seem to be working with. For the Indian markets as well, the sugar industry is looking to divert 2 million tons for the ethanol production. We do understand that the government ethanol blending target is at about 20% by 2025. There have been various reports in the recent days on how the sugar industries are increasing capacity, putting in more investment as well for ethanol in coming years. Well, when you look at the sugar numbers itself for the Indian markets, the sugar exports are near target of around 6 million tons. This is what the Indian government had mandated and given a subsidy for. We also understand that 5 million tons of sugar within this already has been contracted. 2.6 million tons has been exported, and there are more export orders which the industry is looking for from Afghanistan and Iran. So there is some good news coming in on the sugar way, and we have seen the sugar stocks in the recent few days continue to react to that.
Manisha, thanks very much for that. I mean, stocks here, by the way, have been buzzing off and on. I mean, that's a space where, I mean, it's a sector move. It's not as if one stock will move or two will move. I mean, actually, mostly it's not even a region-specific move. Sometimes it is, but largely when it moves as a full pack. So Manisha talking about sugar, which is in focus. Well, let's talk about the economic impact as far as the COVID wave that we are experiencing across the country is concerned. We have Kaushik Das now joining in to run us through what he's making of things. He's Director and Chief Economist India at Deutsche Bank Research. Kaushik, thanks very much. Great to have you here. You published a report titled "What Will India's Plan B Look Like in Case of an Extended COVID-19 Second Wave?" Just clear up the what you define as an extended. I mean, what's the base case? What would you consider as extended? Are you talking about fiscal and monetary responses here? Just contextualize this for us.
Morning, Prashant. Basically, there's a lot of uncertainty now because of the kind of second wave that we are seeing, which is almost 3 times more vicious than the first wave that we saw, which peaked in September. So the report, the idea of this report is that in our base case scenario, we are expecting growth to be at about 10.5% YOY for FY22, which is itself very conservative. And we have had this forecast from last year because we built in some COVID-19 related uncertainty when we did this forecast. So we were hesitant to give a 12-13% forecast for FY22, even last year, thinking that there could be some problem of second wave. So that's playing out. So we don't need to reduce our forecast as such from 10.5 that we have at this stage, which already builds in this uncertainty. But I think consensus was higher, and they probably have been reducing over the last few weeks on the growth side. Now, even if you get 10.5% growth, which is what RBI is projecting, and about 5% inflation, that I would consider as a base case scenario, even with this uncertainty that we have, because we have a very positive base effect from last year, and therefore growth would be, on a YOY basis, at least pretty strong in FY22. Now, the problem is that we are expecting that because of this localized lockdowns and night curfews and what have been announced in different states, that will help over a period of time. Maybe by the time we come to the end of May, we will see the numbers plateauing and the COVID-19 numbers will come down. And it's very encouraging that the government has now allowed everybody above 18 years to be eligible for getting vaccinated. So vaccination will also get a boost. So the base case scenario remains that in 2 months' time, you'd see the numbers plateauing off. It doesn't happen immediately. Obviously, the numbers have gone up. It will take some time. But then, after these 2 months, you'll see numbers coming down, and, people will not be as concerned as they are at this stage. So in that scenario, you can still have 10.5% growth. But the extended scenario is that if you keep on seeing numbers going up even into June and July, despite the lockdowns, and then the question of whether a nationwide lockdown is required for 14 days or a month, that kind of a scenario comes about at the last case option. So that is the extended scenario, and along with that, you'll have fears of a nationwide lockdown for 14 days or a month. That can have tremendous impact on growth. Even our 10.5% growth may not be met in that case, and it could be much lower. In that scenario, what would be the policy response, not just from monetary and fiscal side, but from regulatory side as well, which is, for example, a one-time debt restructuring that was announced. So that's the theme of the report. I'll be very happy to take questions from you on this.
Absolutely, Kaushik. That was going to be my next question. In fact, you did speak about how it would impact the economy severely in case the cases do not plateau in next 2 months. That is what you are expecting. But in case that does not happen, what are the other forms of policy support that you're expecting in case there is a severe adverse impact of COVID-19?
So let's start with the monetary policy, because monetary policy has been doing most of the hard lifting, heavy lifting in since last year to support growth. So we know that RBI has started a little bit of calibrated exit from the beginning of this year. They have announced this thing called variable rate reverse repo auctions, which is about INR 2 trillion as of now compared to the surplus liquidity of 7-8 trillion. And the cutoff rate of that particular auction is coming at 355 when the reverse repo is at 335. So the base case scenario assumes that you will continue to have VRR options going forward, and that 2 trillion INR auction can increase to 3 trillion going forward. And then if most of the short-term rates are clearing at 355 or higher, then RBI may see justification to increase the reverse repo rate, which is today the operative rate and at 335, closer to 355 first and then towards 375. By the end of this calendar year. So that will bring the repo and the reverse repo rate spread at 25 basis points. Currently, it is at 65 basis points. That's the base case scenario. Now, if you have an extended COVID-19 problem, the first response, I think, from RBI will be to temporarily stop the VRR auctions. And what that might do is that might push short-term rates that are clearing at 355 for VRR and closer to repo rate, closer to reverse repo rate might fall even lower than the reverse repo rate. And then what we think is that RBI may bring something called a standing deposit facility, which is not there, which becomes the floor for interest rates. And so that RBI ensures that, the short-term rates, even if they fall, they don't fall to 2.5% or 2%. So that standing deposit facility could be brought at, say, 3%, lower than the reverse repo rate. So that will be implicitly seen as a rate cut, even without touching the reverse repo rate or repo rate. We think that no further rate cuts are not required from the repo rate or reverse repo rate point of view, because they're already low, and you have to think of savers who are putting their money in fixed income returns. So you can't have more rate cuts from the reverse repo point. But if you bring a standing deposit facility which is lower than the reverse repo rate, that will itself be seen as a rate cut. And the short-term rates will all converge towards 3%, because RBI will also be maintaining a lot of abundant liquidity in that scenario, instead of reducing the liquidity sequentially, which is what we expect in our base case scenario. So RBI will be doing GSAP, will be doing OMO, will be doing different types of operation twist to ensure that there is sufficient liquidity, and will not reduce liquidity sequentially in the worst case scenario. On the fiscal side, we have already had a higher fiscal deficit target for this year, 6.8% of GDP. I don't expect the government to increase that number any higher if there is a problem on the revenue side. I think they will try to prioritize expenditure in sectors which need the most, and cutting back on sectors where you can still have cost saving. And remember that we have had capital expenditure budgeted at 5.5 trillion INR, very high this year, which is almost a 26 to 30% increase from last year. So if the situation becomes such that you have to kind of meet the target of 6.8, then there could be some cut in capital expenditure, but that will be the last case option. I don't think government will want to cut capital expenditure to support growth. And on the last front, on the regulatory front, what we can expect is that the one-time debt restructuring that was announced for MSME and the individuals, which got over on 31st March 2021, that could get extended maybe by 6 months if the situation warranted it. I don't think that is required for the corporate sector, because they have not asked for debt recast in this cycle that much. But for the MSME and the individuals, that might be warranted in the worst case scenario. And the last thing is there might be more liquidity for maybe NABARD, SIDBI and National Housing Bank, just to ensure that there is enough liquidity that can go into different parts of the economy. And RBI obviously can do more TLTRO, which is targeting liquidity to certain sectors which need the most.
All right. Okay, Kaushik, thank you so much for joining us and giving us your perspective on what could the macro impact be of the additional lockdowns that we are seeing in different states of the country. With that, we'll take a break, but a quick programming reminder, CNBC TV18 and Google bring together a panel of eminent EdTech leaders, founders, VCs and industry experts at the Education Next Summit, supported by Startup India on April 22nd and 23rd. This high-powered summit will give you a sneak peek into emerging trends and changing consumer behavior that will help you drive user acquisition and gain a deeper understanding of the export market. For details and registration, you can log into educationnext.in.